Hey, what's up everyone? Welcome back to the channel. Are you afraid that your investment would go down in price? Well, guess what? You can capitalize in any direction your investment would lead to. What if I told you that you can make money when a stock goes up and make money when it goes down? Sounds too good to be true, right? Well, welcome to the world of longing and shorting. These are some of the fundamental moves in investing. And by the end of this video, you'll know exactly what they mean, how they work, and how real investors use them every single day in the market. Let's break it down. First, let's talk about what it means to go long. This is the one you already know, even if you've never heard the term. Going long simply means buying a stock because you believe its price will go uppy. Here's a simple example. You buy 10 shares of Apple at $150 each. You spend $1,500. 6 months later, Apple is trading at $200. You sell. That's $2,000 back in your pocket, a $500 profit. Congratulations, you just went long on Apple. Going long is betting on growth. You're saying, I believe in this company. I believe its value will increase over time. It's what most everyday investors do, whether they're putting money into index funds, blue chip stocks, or the next big tech company. You buy, you hold, and you profit when the price rises. The risk, if the stock drops, you lose money. Simple as that. But your losses are capped. The worst case is the stock goes to zero and you lose what you put in. Now, going short. This is where it gets interesting. Shorting a stock means you're betting the price will go down. You're profiting from decline. But how do you make money on something losing value? Here's the idea, and pay attention because this is the key concept. When you short a stock, you borrow shares from your broker. You sell those borrowed shares immediately at the current market price. Then you wait. If the price drops, just like you predicted, you buy those shares back at the lower price, return them to the broker, and keep the difference as profit. Let's use an example. You think Tesla is overvalued at $300 a share. You borrow 10 shares and sell them, pocketing $3,000. A few months later, Tesla drops to $200. You buy 10 shares back for $2,000, return them to the broker, and keep the $1,000 difference. That's your profit. But here's the critical risk, and you need to hear this. When you go long, the most you can lose is 100% of your investment. When you go short, your losses are theoretically unlimited. Why? Because a stock can only fall to zero, but it can rise forever. If you short at $300 and the stock shoots to $600, you're now on the hook for double what you started with. This is why shorting is for experienced, risk-aware investors only. So keep in mind, this is for educational purposes only and not financial advice. Please do your own research before making a final decision when shorting. Now, the market is a constant battle between longs and shorts. At any given moment, some investors are going long on a stock and others are going short on the same stock. They can't both be right. Think of it like the zero-sum game. When one loses, the other wins based on betting the opposite direction of how the stock will move. Longs believe it's undervalued. Shorts believe it's overvalued. The price moves based on who has more conviction and more capital. You've probably heard of the GameStop saga in 2021, a heavily shorted stock by large institutional investors. This historic stock market event caused retail investors to coordinate in a large scale on Reddit, where many people drove up the price of the stock by buying up the stock and forcing the large institutions to buy back the stock at a higher price to reduce their losses of the short. So the simple rule of longing and shorting is as follows. If you believe in a company's future, strong earnings, great leadership, and a growing industry, go long. Buy the stock and give it time. If you think a company is overvalued and maybe the hype doesn't match reality or the financials are weak, that's a potential short opportunity, but only use shorting if you understand the risks, have a clear exit plan, and ideally you're working with tools like stop loss orders to limit your downside. Beginners, stick with going long. Master the basics first. As you grow your financial knowledge, you can explore shorting, but always with caution and proper risk management. Now let's recap. The market is a two-way street. Both are tools in a smart investor's toolkit. The key is knowing when to use them, why you're using them, and how much risk you're willing to take on. Finance doesn't have to be complicated. And that's exactly why we're here. If this video helped you, drop a like and subscribe. Let me know in the comments, are you more of a long investor or do you find shorting interesting? I'd love to know. I'll see you in the next one.